Good afternoon, everybody. Thank you for joining me. The webinar will begin in 2 minutes' time. Just going to wait for a few more attendees. So just bear with me and we'll be back in approximately 2 minutes. Okay, good afternoon, everybody. Thank you very much for taking the time to join this webinar this afternoon. My name is Mitch Young. I am the co-founder of Fusion Consulting, and we are LiFE Residential's recommended tax partners. We help our clients with all sorts of tax compliance and advisory. I've been working in property taxation for a number of years. Today's webinar comes at an interesting time and climate in the UK. We've got the forthcoming budget being announced on the 30th of October, coupled with Brexit announcements going on at the latter part of next year, and the obvious threats to the government from Labour and Corbyn. Taxation always changes and comes into play with political movements, and we have seen across certainly the last 12 to 18 months a number of changes to how landlords and non-resident individuals are. So it's important to try and keep as up to date as possible with ongoings. It certainly keeps us in a job, but hopefully this webinar will provide you with where we are with the current legislation in the UK and how to be compliant. So here's the agenda for today. You will see we're covering off a lot of compliance about what should be done, what you can claim, what returns needs to be submitted, how to bring your tax affairs up to date, along with the recent changes to taxation in the UK and potentially some tips for tax planning. Rolling along the screen in the bottom left of each slide, you will note my email address, whereby we're offering all attendees of the webinar a free 15-minute consultation with myself. I'm happy to arrange that via Skype or any other communication method. If you would just like to send me an email, perhaps outlining your situation and a convenient time to call, then I'll be more than happy to speak with you about your personal circumstance. Furthermore, if you do have any general questions that you may wish to ask during the webinar, there is a questions box, I believe. So if you would like to enter your questions, and as and when they pop up, if they fit what we're talking about, I can discuss then, or I may leave to the end, or if they're a bit more personal, then I will just contact you after today's webinar. I'm hoping the webinar will last around 20 to 25 minutes. We're trying to cover a lot. As you can appreciate with taxation, it's important that we don't leave anything out. So hopefully we will get through it. And obviously, speaking about tax can be a dry subject, so I'll do my best to make it as entertaining as can be. So the first topic on the agenda is selling a property. What is the situation, the circumstances, the reliefs that are available when you sell a property? So first, if we just look at selling a UK property and the basics as an individual residing in the UK, you pay capital gains tax on the profits made from the sale. So the profits are quite simply what you originally purchased the property for, less what you sold the property for. And if that means a profit, then you will be subject to pay tax on that profit. Capital gains tax is charged at either 18 or 28% in the UK. This is based on bands, different brackets. So essentially, you have a bracket of up to £33,500. At this level of gain, you would pay tax at 18%. And then over and above that amount, you will be paying tax at 28%. Now, it's important to note on this point that everyone who sells a UK property is entitled to an annual exemption. This is an annual amount of gain of which you can get up to without paying any tax on. And on an annual basis, this currently is at £11,700. So if you make a gain on the sale of your property of £10,000, then there will be no tax to pay. Over and above that amount, you'll pay tax according to the various tax brackets. If you have sold a property in a trust also gets an annual exemption, but this is half of the amount. Capital gains tax rates on companies is currently at 20%. And it's also important to note on the profit that you can deduct associated costs in buying and purchasing the property. So, for example, solicitors' fees, those can be deducted when calculating the overall net profit position. You can also deduct capital expenditure, and this is a point I'll come on to when we're talking about the rental income. So, capital expenditure is items of expenditure that whereby significantly increase the value of the property. So that could be if you've converted a garage, if you've converted a loft, if you have installed a brand new kitchen which was significantly material to the old kitchen, then all these costs are what's called capital of nature. And rather than deducting these costs against the rental income, you deduct these in the capital gains tax computation when you sell the property, therefore reducing the gain and reducing the amount of capital gains tax. So it's important to keep a note of all these large items of expenditure, and and discuss with your tax advisor on a year by year basis as to what will qualify as capital and what will qualify as revenue. So there is a question saying, what is the implication for a non-UK resident individual? And that is on our next slide. So just bear with me on that point. When dealing with capital gains tax, there are a number of reliefs. The main relief associated with capital gains tax is what's called principal private residence relief. Essentially, if you have at any point owned the property and lived in the property as your main residence, then you can qualify for this relief. Let's say you've lived in the property and you've moved overseas, then for a period of time, the gain can be prorated for the amount in which qualifies for principal private residence relief. Once the property qualifies for principal private residence relief, you also automatically get the last 18 months as a deduction is exempt from capital gains tax. Potentially, you can also qualify for what's called lettings relief as well. So if there can be any planning around the qualification of principal private residence relief, then you're likely to achieve quite a substantial amount of relief. The minimum is an 18-month pro rata period. In order to qualify for principal private residence, there's actually no statutory guidance or timeline in terms of what can qualify as principal private residence. It's about the purpose, the intention, the quality of where you've been living. So it's important that you keep accurate records of utility bills, council tax bills. Case law has proven to the extent where an individual has taken photos of themselves living there and spoken to their neighbours and got evidence that way. So just bear that in mind. One thing to note, just to finish off, is that when you do sell a property, you have to declare the transaction on your self-assessment annual tax return. So these will be in the additional capital gains tax pages, and also if you are claiming any relief, then the additional information spaces should be filled out. If you do not fill a self-assessment tax return in, then you'll be liable to statutory penalties of £1,500 per year, increasing, plus interest on any outstanding tax that should be paid. Sorry, one further thing, if you did make a loss, a capital loss, and not a gain, then you would still complete a self-assessment tax return and document the loss. In the cases that you do make a capital loss, the loss can be carried forward to be used against any future capital gains. Okay, so moving on to non-residence and capital gains tax. So there was a new legislation brought in a couple of years ago for, oops, sorry, the screen has just moved on one, for how a non-UK resident individual is now subject to capital gains tax. So what this means is that when a non-UK resident sells a UK property, they must now declare the gain and pay capital gains tax on it. Capital gains tax is as per the last slide at 18 or 28%. And as I said, as a non-UK resident individual, you will also be entitled to the annual capital gains tax exemption of £11,700, and you will also be entitled to the qualification of principal private residence relief, if indeed this is applicable or can be applicable. For a non-UK resident selling UK property, they have a number of options as to how they are taxed or how the tax is calculated. The government have said that because this legislation was recently brought in, they can rebase the original cost of the property to the market value as of April 2015. So this is very important because obviously if you had purchased a property many years ago and it's significantly increased in value, then you're likely to benefit from this April 2015 valuation because it's substantially going to reduce the gain. If you are going to use this method of calculation, then it's important that you obtain a valuation. Now, a valuation can be via an estate agent or a number of estate agents, but it's recommended you use a RICS qualified surveyor to obtain this and then keep on file if HMRC were to ever ask as to how you obtained the valuation. Now, there's extra compliance for a non-UK resident who has sold a UK property. They have 30 days from the date of the sale to submit an additional tax return. So this is called a capital gains tax return for non-resident individuals. And it's a 6-7 page document whereby you have to choose the method in which you're calculating the gain and the valuation and submit to HMRC with the obvious details of all the property within 30 days. Failure to submit this within 30 days will result in an automatic statutory £100 penalty. And then 3 months later, the penalties increase to £300, and then so on and so forth. And the revenue are very strict with these deadlines. We've seen a number of penalties being issued for late submission of these, purely because clients were unaware of the new rules and regulations, but the revenue don't accept that as a reasonable enough excuse. One final point is that you need to complete the capital gains tax return 30 days after, but then you also need to complete a self-assessment tax return declaring the gain. So it's 2 tax returns in that year of sale. Okay, so that's covering off when you sell a property. Let's talk about a landlord's UK tax responsibilities. So firstly, as a non-resident individual, you should be obtaining and registering as a non-resident landlord. Now, we know, having worked very closely with LiFE, that they do this for their clients, but equally, if you haven't done so, please speak to one of the managers at LiFE or indeed contact us and we will help with that. Once you've registered as a non-resident landlord, then essentially you have 2 choices of how you'd like to be taxed. The first is paying tax at source. So once you register as a non-resident landlord, you can pay tax at source, so that's 20% off the rental. The monthly rental income gets deducted via the letting agent, and that gets paid over to HMRC. Or you can elect to have the rental income sent to you gross. Now, in order to obtain or get permission for the rental income to be achieved gross, you need to show to HMRC that your tax affairs are up to date, that you are indeed a non-UK resident individual, and then HMRC will write to you to confirm that and to the letting agent that you can receive the rental income gross. It's important to register for self-assessment. So every year you would need to declare the rental income and expenses to HMRC, as well as any other UK source information and residency pages on a yearly basis. So the tax year in the UK runs from April to April and is always essentially a year behind with the filing deadline. The filing deadline is always the 31st of January. So at the moment, we are filing tax returns for the year ending 5th of April 2018 with a filing deadline of the 31st of January 2019. So we often get asked about allowable expenses. So we've mentioned briefly looking at capital expenditure, but it's also important to look at what doesn't qualify as capital expenditure, what's revenue expenditure. So basically, anything that any costs incurred in running the rental property can be deducted. So that's things like the management costs, letting fees, insurance, mortgage interest, finance costs. So just going to caveat mortgage interest because we've got a slide on that coming up. And repairs and maintenance. So repairs, where essentially you're just repairing or replacing something like for like, then that can be deducted against the rental income on a year-by-year basis. But as I said, if you are repairing a cupboard in the kitchen for like, then yes, that can be deducted on a year-by-year basis. If you are replacing a whole kitchen to a new modern kitchen, then that will be qualifying as capital. One other note is that if you are traveling to view the property and sort out some issues, then as long as the trip is purely just to go and visit that property and it's not for any leisure, then that the travel costs can be deducted as well. If you are making losses, then the losses can be utilised against future rental profits. So more often than not, clients and potential clients are saying to me that because they had no tax on their properties, they've never declared their rental income, or they never believed they had to declare their rental income, or it was below their personal allowance, or they were making small losses. But this is all incorrect. Everyone that is renting a UK property has to, by statutory law, submit a self-assessment tax return. If you do not submit a self-assessment tax return, HMRC can issue statutory penalties of up to £1,500 per outstanding year. And we've seen on numerous occasions over the past 12 months of clients receiving letters from HMRC saying, we have become aware that you rent out a property and therefore we're requesting all the information. And they're not only liable for statutory penalties, they're also liable for additional penalties for failure to disclose. And moving forward, this can be up to 110% of any outstanding tax plus criminal prosecution. Currently around the world, there's an exchange of information taking place with banks, finance companies, whereby HMRC have access to a lot of information, land registry. So it's vitally important your tax affairs are up to date. Now, the good news is that currently there's a little known voluntary disclosure available to any landlord who has never disclosed their information to HMRC. You can register for this campaign disclosure, and once you're registered, HMRC cannot investigate into your affairs. You then have 90 days to submit all the outstanding property accounts and all the outstanding tax returns and submit that over to HMRC. And then within 4 weeks, they will send a notice and a certificate saying your tax affairs are fully up to date and please proceed moving forward to keep them compliant. Now, the benefits of doing this is that 1, you'll get no criminal prosecution. 2, if there is no tax to pay, then there's no penalties whatsoever. You reduce the statutory penalties. The penalties, if there is tax to pay, is just reduced to sort of 10% of the outstanding tax, and it's just it gives you complete peace of mind. We have helped hundreds of clients successfully register for the campaign and bring their tax affairs up to date. And certainly people I speak to are very happy when I mention this to them, because they don't know where to start with in bringing their tax affairs up to date. So if indeed this situation applies to you, please send me an email and I'll talk you through the process, and we'll handhold you through the bringing your affairs up to date. Okay, moving on to some general tax changes in the UK. So we're going to really focus here on the mortgage interest relief reduction. Just a couple of other points to note before I go on to the mortgage interest relief. So rental room relief has been increased to £7,500. Probably won't apply in your situations, but if you are renting a room in your own property, then you'd get an additional allowance. So I've just seen a few questions pop up here. So let me just get around to them. Is that the same property held under a company name? Yeah, if you're holding a property under a company name, it depends if it's a UK company. If it's a UK company, you'll need to follow the regulations and submit various tax returns. Does this relate to overseas properties or just UK properties? Depends on where you're resident. If you're non-UK resident, then the HMRC are only concerned about your UK properties only. If you are UK resident, then yes, you'd need to declare all your foreign properties. So just going back to it, wear and tear allowance, this was for furnished properties. That's now you could deduct 10% of the gross rents. That's now been removed, and you can now deduct the replacement of furniture. ATED, so ATED is an additional tax whereby if you own property within a company and the property is worth £500,000 as of the 1st of April 2017. So if you're owning a property via a company, then if the value is above £500,000, you will need to submit an additional tax return, so another layer of compliance, and potentially pay tax depending on your situation. So again, if this applies to you, let me know and we can discuss how that works. But anyone who's owning property within a company has to be aware of this ATED, annual tax on envelope dwellings, regulations. And of course, we know about the additional stamp duty. So just to caveat the extra 3%, this is if you're owning property, and it applies overseas as well. So if you're owning an additional property, then you'll be subject to the additional 3%. So let's look at more detail on the mortgage interest relief. So what is happening is the government have reduced or is reducing the amount of mortgage interest you can deduct against the rental income when computing the profits for tax purposes. So previously, if you had a rental property and it was getting £10,000 and you have a mortgage interest of £10,000, you would have no profit and therefore no tax. When this becomes fully phased in as of 2020, if the government are saying in that situation, you'll have to declare the £10,000 rental income, but you won't be allowed to deduct the £10,000 of mortgage interest against the rental profits. Instead, how this actually gets calculated is it gets calculated as a 20% tax reducer. So in this scenario, what will happen is that you'll have your £10,000. It will be taxed according to the tax brackets, and then from the tax, 20% of whatever the mortgage interest figure is gets used as a tax reducer. So this essentially is going to create a lot of artificial profits for landlords, and also unexpected tax liabilities for them if they haven't done their projections or planned anything. So if your properties are heavily geared, then it's important to speak to your tax advisor, work out how this is going to affect you over the next few years and whether any planning can be done. So just to cover off that point, you can see on this table that from the current tax filings, you can deduct 75% of the whole figure, and only 25% gets used as a tax reducer until it's fully phased in the year 2020-21. So in practice, what this has led to is a lot of clients seeing if they should look at a corporate vehicle. If you are looking at a limited company and owning property, then the full mortgage deduction within a limited company can be offset. So for some people it works well. Obviously there's a lot of structures in which you can own property in the UK, all of which have their different tax implications. So whereby a limited company may be good from a corporation tax or income tax point of view, long term you may need to look at the implications of that. You can look at a partnership potentially, an LLP in the UK, or indeed a trust, but equally you'll need to do some analysis with a tax advisor as to what is the best structure. A lot of clients are looking at the long term. There is now inheritance tax on residential property in the UK, so one needs to be aware of that and how that's going to affect their estate and what planning can be done with that. You could look at gifting, but gifting, there is also capital gains tax implications on a gift to a child, potentially. So again, some tax planning needs to be done, but there could be options there. As a non-UK domiciled individual, if you are coming to the UK or planning to come to the UK, there's a very complex tax system in operation. A non-domiciled individual is someone who was not born or brought up in the UK. So if you are thinking of coming to the UK, or indeed you are a non-UK domicile, then quite a lot of planning needs to be done beforehand. So that brings us to our final slide, just as an overview of who we are. So as we said, we're experts in property taxation, active over hundreds UK landlords in association with LiFE Residential. What we will do is become your tax agents. So we will handle all correspondence with HMRC. We will ensure all deadlines are met on a year-by-year basis, ensuring that you're tax efficient as possible. We have a relationship with LiFE Residential whereby once you sign our engagement letter, LiFE Residential provide us with all the rental information, so it's quite a hassle-free process, and our fees will be offset and deducted and collected via the LiFE Residential account. Our fees on a annual compliance basis are £50 a month, and that covers everything from the self-assessment to the rental property accounts to acting as your agent, and it also includes tax fee investigation insurance if ever you are investigated by HMRC. So thank you very much for listening today. Hopefully you found that very useful. I'm sure you all have a lot of questions and would like my advice on a number of things. So please email me and get in touch, and I'll be delighted to hear from you and honour the free 15-minute consultation. So I'll leave my details up on the screen for a few more minutes, and I'll just have a quick look at the questions just to see if I missed anything. Yeah, so there's one final question that's been asked, which I think I didn't cover. Do you, as a non-resident, can you get a personal allowance? So you, as a UK citizen, you can get a personal allowance against rental income of £11,500. So yes, as a British citizen, you will be able to offset your personal allowance against rental income. If you're not a British citizen, it will depend on the country in which you're residing, and the double tax agreements between the UK and the country in which you're residing as to whether you can obtain a UK income personal allowance. But as I said, the capital gains tax allowance is for anyone. The income tax allowance is for British citizens, EU, and a select few countries whereby there's a double tax agreement in place. Okay, so thank you very much, everyone, and my details are on screen, so I hope to hear from you.